And listen, Allie, our listeners would love to be buying more new homes, but the builders just aren't building for the bread and butter rental market this time around, sadly.
The whole point of going through that segment was really to build up why are we talking about a change in policy right now? And the reason that we would even be talking about some kind of rate cut is because we're seeing the economy is slowing, and whether or not it's tariffs or whether or not it's uncertainty or whether it's not, we've just had a long expansion and businesses are finding it hard to profitable today. There's a lot of different factors that could lead to that. But historically, when you look at rate cuts, we see it happens during or after a recession, or you see it in an effort to pump up an economy. And so right now, we're hoping that if the Fed, and it'll be likely that the Fed does cut rates later this month in July, that's their insurance policy. They want to pump it up. They want to prolong growth. And that's half the time that happens. And half the time, it's too late and things start to turn down. And you can see that here in this graph. This basically just shows you different times that the Fed has cut rates. This is the 1990s expansion, which is the second longest on record. You saw they cut rates, stimulated growth, they were able to raise it, and then a couple little cuts before the final cut before a downturn. So it'll be interesting to see where we are, because as we showed, there is some slowing in the economic data, but the question is, will a 25 basis point, if that's what they end up doing, so that's 0.25%, if they cut rates that much, will that do anything to the market? And I think a more serious and concerning question is, why can't the economy withstand rates as low as they are today? Because you can see on this graph, we've really never had this before, any kind of prolonged period where the short-term rates are as low as they are.
Okay, so when you say we've never had this, we've had the short-term rates very low for a very long time. This is the longest.
Yes.
Yeah. Okay. Interesting.
Yes. Yeah. And almost, to me, I'm trying to coin this as my thing, but I could see the next downturn being called the Fed-Induced Bubble, because when you have rates this low for this long and you're yield seeking, you're going to try to find different ways to make money. And maybe it's creative, and maybe there's things that's going to come out of the woodwork, and maybe I'm just being alarmist and I don't know, and there's nothing actually going on. But I think this has allowed for some risk taking that maybe we should be aware of.
And you know what is very sad about that, Allie, and all of us critics of the Fed, and I'm talking critics conceptually, that there is a Fed, okay, that there is a central bank, and the market's not just allowed to kind of regulate itself, right? Especially being a private company, and there's a lot of people that are very critical of all of the way the system is. And what's really sad about it is that because the yield is so low, it punishes savers and it rewards debtors, right? And so these older people that have done the right thing all their life, they've saved up money, they've delayed gratification, they didn't spend when they might have wanted to enjoy life a little more, they saved for retirement. They did the right thing. And now they're forced in this position where they've got to invest in riskier speculative assets. They can't buy, CDs and ladder them. They can't buy bonds. They can't do the conservative stuff that this class of people used to be able to do in the old days, because there's just no yield.
Yeah. It is, and it not to go into wealth inequality, but it does create, if you're not investing in the stock market, think about all your friends who were invested in the stock market over the past 10 years, and all of the average Americans who maybe didn't know that they should be doing it or didn't know how to do it, and then how you just see that huge gap between the people that I guess were a bit more investment savvy and those that were looking to do some kind of safe, they don't want to take on too much risk. As we talk about then for your investors, and as you think about the home building industry, for so long, we've been so focused on what is the Fed doing and what is that going to mean for mortgage rates. And you've seen that, yes, in the past, you can follow this. There are times that the federal funds rate, which is the rate that the Fed can hypothetically control, you're seeing that as it goes down, you see a similar trend in rates. But as we've gone through this prolonged period of zero interest rates, and as we've started to slowly raise, like I said, 9 times throughout this cycle, we haven't seen the accompanying change in mortgage rates. And when I do presentations, I often have people say, well, that doesn't make sense because why are we not seeing that they move in lockstep? And the answer, and I think, Jason, you probably know, is that it's not really the focus of the federal funds rate. It's really what the bond investors are doing and how that impacts the treasury yield, because these are more competitive investments and they tend to move together closer than the federal funds rate.
I'm glad you brought this up. So the bond market controls the mortgage rates. And of course, I've said this a million times, but people just sometimes I don't think they want to hear it. Understand, the Fed does not control mortgage rates. The Fed does not control mortgage rates. They influence them, obviously, but according to your chart, not that much.